All right. Thank you, everybody, for joining us today. My name is Jonathan Lee. If you are not familiar with our webinar series and our organization, we are the Foundation for Financial Education. We're a 501c3 nonprofit. Our mission is to bring educational resources directly to the public. We have a variety of topics that we usually educate about, and today we have a very special guest speaker who I'll introduce in a second, and we're going to be talking about mortgages and real estate opportunities. So, a lot of people have a lot of different levels of experience on this topic. So we're going to start with some very basic things, and then we're going to try to hopefully evolve our conversation to some more advanced idea sharing. But before we get into too much detail, I did want to let you guys know that we have on our webinar today, Virginia Liu. She and I go back probably over 20 years. And she's been doing mortgages for a lot of my clients, and I don't think I've ever had anybody come back with any type of anything other than a accolade or compliment or thank you for sending them over to her. And she's very well versed. She's worked for very large banks like Bank of America. She now works with a local bank, which I think is fantastic because they have their own money, and a lot of times you don't have to deal with companies buying and selling your loans and things like that. But in any case, she is here to enthrall us with her expertise and her experience. So, Ginny, are you on the line? Can you hear us?
I am. Pleasure to be with you.
All right. Thanks for being here today. Before we get into any specific things, I did want to read our disclaimer real quick, as usual. So, we are a nonprofit educational foundation. All of our members and experts are volunteers, and we are not advocating for any recommendations or advice with anything related to anything mortgage or real estate advisory. If you are interested in getting some specific advice or recommendations from somebody, we highly suggest that you seek out somebody who is licensed and certified in the area in which you are looking to get that type of advice, to seek professional guidance so that you can get recommendations, especially in the areas of taxes, legal, real estate mortgages, investments, insurance, or things like that. So again, this is for educational purposes, and we hope you have a good time today. So that being said, we're going to just jump right in, and I'm going to allow Ginny to talk a little bit about why, even in this day and age, it's such a good benefit to be a homeowner in this day and age, and how we might be able to help you guys, if you're not already a homeowner, become a homeowner, and potentially maybe even as you transfer into retirement, why you may want to be a homeowner in that situation as well.
Certainly. So there are a number of benefits, of course, to owning your own home, and hopefully we're going to take all the mystery out of that process and how to make that happen. Benefits of homeownership can be all across your lifetime, from just, your very first starter home, building equity, which means that as you keep making your mortgage payments, or if you own a home for a long time, if the value of the house goes up, that's your money to keep later on when you sell it, or if you refinance to take some money out. That's a benefit that you can't have as a renter, no matter how good your setup is with your landlord. Ultimately, when you're paying rent, you're paying a mortgage for someone else or building equity for someone else. So absolutely, your home can sometimes be one of your greatest assets, and certainly a lot of personal security goes along with owning your own home.
And so not just owning your own home in that regard, but let's also just briefly discuss, if you don't mind, Ginny, the benefit of maybe even owning an investment property. One of the things that people have sort of commented to me about is, over the years and the decades, real estate has been a pretty sound investment. Now, of course, we're sort of in the DC metro area, so it's not necessarily the same for everybody. Some people may have better or worse experiences, but one of the things that I've found is that the gains when you sell a house, the capital gains taxes are oftentimes some of the lower taxes that you would have to pay. So, like if you compare capital gains taxes to income taxes, if you could profit on a home or a real estate investment, you might actually pay less tax than you would have to pay otherwise. Does that sound reasonable to you?
Definitely. And then, again, you want to consult with a tax advisor for specifics. But in many cases, just generally speaking, there are a number of expenses that you pay towards maintaining a home, or, just kind of taking care of your home, that can be a tax benefit for you on an investment property that aren't necessarily when you own your own home and only your own home.
The recent Tax Reform Act that came down the pike a couple of years ago had eliminated a lot of the deductions, and we'll talk a little bit about your home mortgage interest, your second homes, your HELOCs, your investment properties. But the one thing that it did not eliminate was the ability to depreciate an investment property. So for those of you guys that don't know, you may have lost the ability to get some tax benefits on your primary mortgage, but you also can still get some pretty humongous tax benefits on owning investment properties and rental houses. They call that depreciation. And in general, depreciation can be as high as 5% per year on the value of the home. So what that basically means is if you have a $400,000 investment property, you could receive around $20,000 a year of tax benefits just from the depreciation itself. So Ginni, do you mind commenting on sort of the double benefit of being an investment property owner? You don't just get the tax benefits, but you also get what? You get the appreciation too, right?
Yes, absolutely. Owning an investment property is much like owning a small business for yourself, where you have income coming in certainly to help with cash flow for your immediate needs, but absolutely the tax benefits really can't be overstated. There's just so many ways that using this as, again, like a small business, you can depreciate it, just as you explained. You can write off various expenses for maintenance and any kind of, expenses that you have for the property, frankly, in so many ways that you can't in other circumstances. So it's a beautiful thing to know that it's likely going to be an appreciating asset that can generate a lot of taxable benefits for you too.
So over the years, I've heard people saying, "Yeah, I'm gonna buy a rental property because I'm gonna have the renter pay my mortgage for me." What exactly does that mean?
Well, it means exactly that. When you have your bill, a lot of times your rental value, the cost that you can recover from someone paying you monthly rent, or even short-term rentals, where people will buy a vacation spot that's real popular at different times of year, and have that rental income offset the cost of the mortgage, and then everything else is profit. And again, you still have a lot of tax benefits waiting for you too on that income.
So I know I'm spending a lot of time on this one slide, and I promise everybody I'll sort of progress further. But I guess the last question, while I have Ginni on the phone, that I wanted to ask her is, what do you think about a lot of people that really want to have a vacation home, but they can't afford to pay two mortgages? Maybe they could, but they don't want to have to maintain the balances of two homes. Is it feasible nowadays to buy a second home and use it as a sort of vacation home, but rent it out when you're not using it to help you recover all the costs associated with owning that second home?
Yes, all the costs and more. So again, when you pick a place in a really popular vacation destination and you use it for your family, maybe in some of the off season, or maybe middle of the week you sneak out of work for a couple of days to spend, you can really make top dollar on the short-term rentals. And many companies out there will do a lot of the management for you, making sure that all the legalities are met, the taxes and things like that for the localities are paid. So there's very little worry in a lot of cases, and a lot of upside potential for a return on your money.
And I would love if anybody wants to see the number crunching on, if you want to buy XYZ property in a resort area or a lake area or a beach area, how much rent you would have to make to break even, or to make it financially worthwhile for you. And maybe, you could use it for a couple months out of the year and you rent it out for the remainder of the time. I think those are the types of calculations I think really help people out with making, those types of decisions. Would you mind, Ginni, talking just briefly about the 4 different types of properties and maybe some of the associated features of these different types of things?
Sure, because sometimes when you see a property listed, it'll say that it's a co-op or it's a townhouse, and you may not know necessarily what the difference is between them. It's not a big mystery to clear up. So a single-family home is detached from other properties, and it's just that. It's one property, maybe with an in-law suite, but not a whole separate unit that you'd go into from a different entrance, and like an apartment building, for example. So just your classic house with the white picket fence, that's your single family home. Where the townhomes are very common in our area, they're attached usually to one or more other properties within like a row house type of setup. And again, you own the property, you own a small bit of the land around it, but a lot of that is maintained by what's called a planned unit development or a homeowners association. So there's a little less maintenance sometimes than a single family home on a larger plot of land. But a lot of times the communities that have townhomes have some community amenities like maybe a tot lot for children, or some of them will have a pool and that sort of thing that's maintained by the community at large. And then condos are more like apartment style living. There'll be multiple units within a single building, but not usually just like one shared wall, like a vertical townhouse that you might see driving around in like Rockville, for example. Condos work a lot like apartments in the sense that you are only maintaining just the inside of your home. Anything exterior is maintained by the condo association. You'll pay higher dues because of that, because you're kind of sharing in more expenses and having more done for you as far as no lawn to maintain. These are great for older people or people who have a very busy lifestyle, travel a lot, and just don't want to be home mowing the lawn. A lot of times they have very competitive amenities, especially in this area. Some of them are really resort style. And then others are great starter homes too. And then finally, there are co-ops where ownership in the building itself is shared among the different owners. So you would own a portion of the building, and it's more like a club where you can have your membership approved or denied by the other members of the co-op. You make many more decisions together as collective homeowners. And there are mostly, these kinds of homes are generally found in DC, although there are some in the Montgomery County area that get a little bit less and less common as you go out to more rural and new development areas.
So this webinar, this educational thing may end up going to people outside the DC metro area, all the way across the country. If we're talking to people sort of in just a general environment, Ginni, if we're talking about investment properties versus primary residences, are there any strategic advantages to looking at one of these four types of homes as an investment property versus a primary residence?
Yes, it really depends a lot on the location. So if your strategy is to appeal to people who are vacationing at a lake, that was an example that you mentioned earlier, that lends itself more to, peaceful, quiet, privacy. You think of those types of things. So a single family home is probably what you're really looking for there, where you can rent out the entire house to a family or, group of friends who are looking to get together and just have some time out in fresh air. Condos are going to be the most value for your buck when you go to places like the beach, when you're right on the water, where lots of people go for things like, spring breaks and real seasonal, where the value of the home could be maybe less affordable and the real estate is more scarce, so you won't find lots of single family homes right on the beach. So a condo is a great place to look for a very affordable way to make a good amount of money. But certainly your market there is going to be for smaller groups and people who'd be better suited to a smaller living space than those who are looking for a single family home.
Sometimes I imagine also the different fees associated with these different types of homes may help you decide whether it's a realistic investment property or not. Because my understanding, I thought condos and certainly co-ops had all kinds of additional fees that could really sort of wipe out any types of profits that you might make in a rental scenario.
Yes, you definitely want to do a careful cost analysis and know before you're making an offer or falling in love with a property that you're very well aware of all the expenses that you could expect, both when you're purchasing the property in like out-of-pocket costs and, the price of the home certainly, but certainly on a monthly basis when you're thinking of which bills you pay. So there's a trade-off on condos. Insurance is much less in many cases because you're only responsible to insure the interior of your condo, where on a single family or townhome, your insurance has to cover the interior and exterior to an extent. But yeah, you definitely want to look because there can be a big diverse group, change in fees from area to area and even community to community, depending on how much of the amenities there are. So specifically for an investment property, there are things like maybe a gym or a clubhouse that would be a real asset to someone who's going to live in that community year round, but maybe not much of a draw to people who are just going to spend a weekend or a week, in the summertime. So you don't want to pay for things that you're not going to see a return on. So you definitely want to know what you're paying for and how much all those fees are, and really go over the numbers with someone who's an expert.
let's talk a little bit. Let's talk a little bit about how to figure out what you can afford. So this would be, probably talking mostly about primary residence, but also if you want to look at an investment property, how do you really know what your price range should be when you start looking at places? And my feeling is, I think a lot of people, might get nervous because they're dealing with a real estate agent or a mortgage person that is trying to or urging them to go for a higher price place because they make more money when they do that. But, really, you're not going to get qualified nowadays, I imagine, for something that you shouldn't or couldn't afford. Isn't that right?
Right. You definitely want to have somebody who's, got your fiscal responsibility at forefront of their mind. There are generally two numbers which would be your maximum purchase price in any scenario. There's the number that you're most comfortable with your individual budget and circumstances to pay. And then there's the amount that the bank feels is your maximum for qualification standpoint, where the bank is comfortable lending you the money. Oftentimes, someone who is careful with their budget is not going to go all the way to the maximum that a bank would qualify them for. Now, from the bank standpoint, they're going to look at a percentage of your total income as your mortgage or your home expense, including the taxes and insurance, any kind of condo or HOA fees like we discussed. And the bank's position on this is generally if you have no more than 43 to 50% of your total gross before any taxes or expenses are taken out income. For a lot of people, that's not quite comfortable. You don't want to have 50% of your money going to just one expense and having to pay your taxes and live on the remaining expense. So it's very good to kind of think about how much are you paying now for your expenses, or how much do you think you're going to profit, like with an investment property per month. Think of those things to know where you are comfortable as far as a monthly payment. And there's ways to get there by either, obviously going for a different price range maybe than the maximum that you're able to get, or, different down payments, different loan terms. There's all different ways to make the mortgage fit into your budget. And if you simply can't, then you just look at a different type of property like one of the others that we discussed. And maybe a townhome would be more affordable than a single family home. So there's lots of different strategies, but you kind of want to go into it with your own numbers in mind of what you think is reasonable, and then speak to a professional to kind of help set the budget around that. And then certainly find out how much the bank is telling you that you're eligible for, and find that compromise that is best for your needs.
Can we talk a little bit about down payments since they're on here now? I mean, are most people, what are the most common loans right now? Are people putting down 20%? Are they putting down less? What do you guys normally see with these home purchases?
It's usually one or the other, John. People who say I'm putting 20% down either because that's the idea that has always been around for years and years, that you need 20% down because there was a time when banks wouldn't lend you any more than that. You'd have to have a lot of skin in the game to make a bank feel comfortable. But these days, there are many programs specifically for your primary home or your vacation home where you can put much, much less money down than that, and as little as 3% in many cases. For vacation homes, for investment properties, you would need at least a 15% down payment in most cases. But the reason that 20% down is such a popular number is because there's certain expenses that you don't have to pay when you have a larger down payment. Sometimes the interest rates are a little bit better for that too. And of course, to keep the monthly cost down. For some people, the cash out of pocket isn't as much of a concern as the ongoing monthly payment, specifically for people who are nearing retirement age. So a larger down payment can be very beneficial in those cases too.
All right, wonderful. Let's talk a little bit about qualifying for a mortgage. Gosh, I keep hitting the wrong button on here. So, a lot of times people obviously are aware that credit is a factor, but is age a factor? Are assets a factor? What are some of the other things, especially as our clients are getting older, that they need to think about when applying for a mortgage to make sure they get qualified properly, or pre-qualified, that is, when they're looking for a house?
Yeah. So first and foremost, age is never a factor, other than if you're meeting the minimum age of being 18 years old to sign a contract legally. But there is absolutely no consideration given whatsoever to someone's age in conjunction with a mortgage application. So it can be a very stressful time when you're emotionally invested in the property that you want to buy, and you've got an application in process, and you're wondering, oh my gosh, am I going to be approved? How will I know if I'm going to be approved? So this slide is pretty good at breaking it down to saying, really, there's only 4 pieces of information generally that a bank even considers for an approval decision on a loan. So first is credit. Credit, of course, is the number that is assigned is the bank's score that they receive from the credit bureaus that indicates the level of riskiness on a numerical scale. So someone who has many credit lines and years of a perfect credit history, meaning no late payments, not keeping big balances on credit cards and that sort of thing, they're considered very low risk. So they're going to get a very high credit score. And that score gives reassurance to the banks that this person is most likely going to be the type of person to continue, based on their past behavior, to make their payments on time and consistently, and you can rely on this person to be a good borrower. Sometimes things can damage credit, and sometimes your credit is just too new for a credit bureau to give a lot of certainty. Just like if you're new at your job or something like that, you're kind of a rookie with credit. So even though you may be off to a good start, it just hasn't been a long enough history for you to get one of those top tier credit scores just yet. So time and patience and good behavior on your credit items is a way to just let that value increase month by month. And then there's people somewhere in the middle where maybe an event has happened in their history that caused a few late payments, or maybe charged up a credit card pretty close to the maximum. And these scores update periodically, and if it happens to be pulled at a time when one of those events has just recently happened or is currently happening, you're going to see a higher risk to the bank, so a lower credit score at that time. There's a number of agencies and strategies that you can use to help boost a credit score, but these days, especially for a mortgage, more than any other borrowing need, knowing that there's a house that's collateral for the loan, your credit score is not as big of a factor with borrowing and qualifying for a mortgage as many other things. So you'll see a much higher interest rate on a car loan, and certainly on a credit card if you have poorer credit scores. But really, the bottom line between somebody with perfect credit and maybe average to slightly below average credit, it's not a tremendous amount of difference in interest rate. But ideally, when you're preparing for buying a home, you want to do the things that will help you boost your credit score as high as you can. And any loan officer can talk you through how to do that. The next factor is income. I touched on this a little bit earlier, that the bank is going to set a magic number to calculate all of your debts versus your monthly income and come up with a formula to say, all right, is it under that number or not? And if it is, then you're going to qualify. And if you're even a slight amount over that number, the bank's going to feel like this is way too much payment for you to handle successfully without it taking over your life and being a real big problem for you. So
hey, do you mind if I ask? So a lot of people ask, do they consider pensions and retirement income? Because can people still refinance or purchase real estate if they're retired?
Yes, and that income is guaranteed, so it's perfect income. It's not, you can't get fired off of your pension, so it's really strong, stable, reliable income. Yes.
Good. I think that's important.
Right, and VA benefits as well. Those things, a lot of them are not taxable, so it can count as even more income than like a W-2 salary, or somebody who has self-employment income. It actually can count for more in some cases than the number on the page. But yes, we'll consider all these income sources. We do look for a 2-year employment history, or for someone who has their own business, a 2-year track record with that, to consider that stable income. And someone who has changed jobs within the same career is still considered to have that employment history. But if you go from one type of job and you change to something different, new career, you may have a waiting period before you'll be able to use that income successfully for a mortgage.
So a scenario that I see quite a bit, Ginny, is somebody will come in and they'll have like $1 million, but not much income, right? Maybe they're just getting Social Security. They don't want to touch their retirement accounts. Can they still qualify for a mortgage?
In some cases, yes. Specifically for people who are transitioning into retirement, there's a way to formulate the balance in that asset account over the number of months of the mortgage. So say we're looking at a 30-year mortgage, that's 360 months. You can take that $1 million divided by 360, and we can impute that as income for the client the same way. But what you're also mentioning is somebody who has a really good record of savings and assets, but maybe their income is a little bit weaker. There are things that compensate in some regard. Like, somebody might say, I could buy this house in cash. Well, if we still see that with all of the measures we have to calculate income and debt, that if you're still going to have a mortgage payment that's more than 50% of your income, it's likely that the bank is going to still feel uncomfortable issuing that loan, because we can't require you to deplete your asset or pay off your mortgage, but we could be kind of putting a stranglehold on your finances by having such a high bill relative to your income. So that's the bank's way to be somewhat fiscally responsible and try to set some kind of guideline to what's reasonable for a mortgage payment.
So are you recommending people nowadays that they get some kind of credit monitoring service, or try to figure out, like I hear these commercials for like Experian Boost and things like that. Are those things important?
I think they are. It's a good way to get a free look at what your credit scores are. Now, some of these agencies, I won't name any names, but there are apps that you can put on your phone for free that will give you your credit score. And the reason those services are provided is they're sponsored by creditors or credit card companies and that sort of thing. So they're hoping you'll provide that information and they'll give you a ballpark credit score, but it's really so they can sell your information to creditors based on your credit worthiness. So you may start getting bombarded with advertisements for credit cards and car loans and that sort of thing. But a lot of times, if you have a bank account or a credit card, these services are provided for free. And I do think it's very important to monitor your credit. If you see a change and you can't kind of draw a straight line correlation between something you did, like maybe you just bought a car, so now you have new credit. And again, remember, I was talking about the age of your credit lines determining your riskiness. If you don't have a lot of credit and you get a brand new car, even though you're not paying late, well, now your average age of how long you've had these accounts is shorter, and it's a little bit less certain. Like, well, how is this person going to do paying this car loan? We don't know yet. We have no history on that. So that could be something that might temporarily reduce your credit score down until you have a couple of months of good payments under your belt, and you'll see your score go up. But if you randomly see your score fluctuate like wildly without being able to connect it to something in your behavior, that could be a signal for possible fraud or identity theft, where someone's using your credit without your knowledge. So it's very good to keep track of that for yourself.
So let's say let's say your credit's not great, but your spouse, has really good credit, or let's say you're a child. Is it a good idea to get a co-signer on a loan? Does that help you qualify for more? Do they look at just the co-signer's information, a standalone? Do they do a combination or blend of both people?
So whenever you have a joint application with any number of people on it, let's say 3 people on a mortgage together, the way that the credit score specifically is looked at is they'll take the person of all the borrowers with the lowest credit scores, and everybody has 3 credit scores from 3 different credit bureaus. There's Equifax, TransUnion, and Experian. Those are 3 different agencies that all pick up information as on your credit behavior, and that's where those scores ultimately come from. So we will take the middle of those 3 scores, which we consider to be the most fair, because maybe in a given month, TransUnion is picking up that you still have a high balance on a credit card, but you've paid it off, and Experian and Equifax, the other 2, are seeing that you made that payment, so your scores are higher with the 2. Well, we're not going to take the very lowest score, and we're not going to take the very highest score. We think the fairest is the one that's in the middle. But whenever there are multiple applicants, a cosigner can actually hurt you from a credit standpoint if their credit score is not as strong as yours, because then we're going to be looking at their credit. How a cosigner normally can help is if, say, 2 people want to go jointly on an investment property, for the down payment, maybe one person has those funds and the other does not. That cosigner can step in to provide the down payment money. The cosigner can also help boost the amount of income so that the total debts between the two of them are not high compared to that new mortgage. So there's a number of ways that a cosigner can help, but you want to just evaluate. Just simply more people on a loan together doesn't necessarily make it stronger. You've got to have something that it's benefiting you from. Either down payment credit scores are not going to be affected by someone with better credit scores than yourself, because obviously you're going to be the lower one on the loan, so we're going to use yours. But certainly for down payment and monthly payment, those things can be helpful with a cosigner.
All right, let's talk a little bit about some of the other costs other than just down payment, so people really know what they're going to come out of pocket for if they want to, buy a primary residence or they want to buy an investment property.
Sure. So as I mentioned, with different loan programs, you can customize your loan by how much you want to put down on the house. And a down payment is just simply you're looking at the purchase price of the home, and your down payment is going to subtract from that purchase price, and your loan amount will be the difference between the two. So that money goes straight to the principal, straight to the value of the house, and nothing else, not fees. You'll have a lower loan the more down payment you make. When we talk about private mortgage insurance later, I can get into that a little bit more. But again, a lot of down payment programs for specifically primary residences and vacation homes will only require about 3% in most cases. Sometimes with somebody with kind of poor credit or issues on their credit, may be asked to put a little bit more down. But as a general rule of thumb, 3% is really what you need as the minimum. In addition to the down payment, now you have closing costs. And closing costs can vary, depends a lot on the purchase price. A lot of times when you're buying a more expensive home, these costs are sort of fixed. So you might pay a lower percentage of your loan amount in fees than somebody who's buying maybe a $100,000 home, because things like an appraisal are going to cost $500 to $700 generally, not much more than that. And a bank will charge an origination fee maybe of $1,000 or so, and that would be across the board for every single loan. But as a rule of thumb, and there's always exceptions, about 2 to 4% of your purchase price would be just for various fees that you pay to acquire that home. So you need that over and above whatever your down payment is.
I'm glad you brought up the origination fee, and a lot of people ask us all the time, hey, should I pay points? Should I pay down my mortgage? I've got this amazing looking rate that looks kind of unbelievable, but there's so many costs associated with getting that rate. Do you normally recommend people pay points to pay down their mortgage rates?
That really depends on a couple of different factors. So there's no one size fits all with a mortgage. It's a very tailored process. And I get a little leery when people just go online and just kind of say, okay, I'm just going to apply for a loan without somebody being there to advise on, is this really the best deal? Is it really the interest rate that's going to be the best, indicator of the cost of the loan? Not always. So for someone who knows that this is their forever home, they're going to have this mortgage for 30 years, then in a lot of cases, it does make sense to pay a little bit more in fees in exchange for a lower interest rate, because over time, having that loan and that lower rate, it will pay for itself. You'll see more savings in interest than you paid in fees. But for a typical person who's purchasing a home, an investment property, that sort of thing, a lot of times you're going to want to sell the house when it's really kind of like due for all that deferred maintenance on an investment property. Maybe it's time for a new roof and that sort of thing. So you may be selling the property 7 to 10 years after you buy it. That's pretty typical for people, even with their primary residences, until close to retirement age. So paying a whole bunch of points to have a beautiful interest rate might work against you if you don't have the house long enough to have that rate pay for itself. Or maybe interest rates drop and you want to refinance. Well, you still haven't recovered all the costs that you paid to get that low rate that you're refinancing now. So it's sort of a fool's bargain in a lot of cases to pay points, because you're basically prepaying interest to the lender, and the lender wins when you do that. No matter what you do, if you refinance in 6 months, sell your house, move away, the bank keeps that money and it's gone. A lot of times, it depends, unless there's a real bargain, and mortgage rates change daily, and sometimes there really are bargains when you pay points. But unless that's the case, a lot of times I'm inclined to recommend for people who are likely to sell their home at some future point, just go ahead and pay the 0 points rate, meaning you're not paying any fees to get that interest rate. And even if it's a little bit higher than what you could get if you paid for it in points or fees, just add a little bit of extra money to your payment every month and you can save on interest for free.
Yeah, I like that. That's a really good point. The other thing I like to talk about is, hey, if you have 50 grand to put down on a property, maybe you could put down 25 grand and buy two properties and leverage the bank's money a little bit better. The same amount of money out of pocket for you, but now you get two houses and you use more of the bank's money. So that's something that I like to talk to people about.
That's a fantastic idea. And a lot of times a lower down payment, and again, when we talk about the private mortgage insurance, we can get into this a little bit more, but sometimes there's a benefit to putting a little less money down and making sure that you have at all times an emergency reserve fund, for expenses that you may not have as a renter, or when you're acquiring multiple properties, sooner or later, one of them is going to need an HVAC system or something will need maintenance that you weren't expecting, or you just want to spruce it up and, make it pretty and put new flooring in and stuff like that. If you put all your money down in a house, it's pretty hard to get it back out unless you refinance your mortgage and pay fees again, or you borrow on another loan and have multiple payments to make. It's better sometimes to keep that money in your pocket for future needs than putting it all down on the house.
So you mentioned PMI a couple of times. I'm just going to kind of jump to that slide real quick. Why is that such a big deal, and how do people know if it's worthwhile for them to put down less and pay PMI, or are there other ways around it potentially?
Sure. So PMI, if you're looking at your mortgage as the only financial position you have, like you don't care about anything else in your life except paying the least amount you can on your mortgage, then a lot of times people will say, I will scrape together 20% to put down so that I don't have to pay PMI. So what PMI is, it's private mortgage insurance. And on some government loans, it's a fixed amount. And in many other cases, it's actually an insurance policy that we shop around and try to find the best rate on among different insurance carriers who provide this to banks. But it's basically a gap insurance policy that covers the bank in case of a default on the mortgage. So let's say, for example, just to use really easy numbers, somebody wants to buy a house for $100,000 and they don't want to put 20% or $20,000 down. They want to put maybe $5,000 down or 5%. A bank might not feel comfortable that if this person goes delinquent on their mortgage and the house has to be foreclosed, that the bank's going to be able to resell that house at top dollar. They're not going to have the benefit of a great realtor who's going to promote the house and sell it. They're going to just dump it as quickly as they can. They won't know really much about the condition of the home or anything like that. So as a rule of thumb, banks say, well, we could probably get a return of 80% of the value of this house if the house went into foreclosure and we had to sell it ourselves. So anytime a loan is for more than 80% of the value of the house, it puts the bank in that tenuous position where a lot of times the lenders used to just say, no, sorry, without 20%, you can't do this. Now with this mortgage insurance, it's a protection for the bank that the house is insured for the difference between what the mortgage is and the value of the home. So if the home sells for less than the mortgage amount on it, the insurance will pay that. So there's a cost to you for this insurance, but the benefit to you is a lower down payment to free up your cash for maybe that other investment property that's going to return much more to you in enjoyment maybe, or certainly in profit than what you're paying for the use of that money by paying PMI. It's also a way to not have to wait years and years for your very first home to save a very large amount of money so you can get into a home much sooner and get away from paying rent. So in a lot of ways, PMI can pay for itself. But whenever you have 20% equity in your home, in many cases, the PMI will go away because there's no need to carry that insurance anymore because you've reached that threshold that if for some reason you defaulted on your loan and the bank had to sell it, they'd probably break even on the balance of the mortgage at that time.
So Ginni, is there a cost for getting the PMI off of your house once you reach that 80% loan to value threshold?
No. There's one exception to this. There is a mortgage called FHA, and that loan has, in many cases, lifetime PMI or PMI that you have to keep on there for a minimum of 11 years. So a lot of times the way out of that loan is to just refinance it when you have the equity. Otherwise, you're going to be paying the PMI. But you have to also look at what are the interest rates at that time. So maybe if you have a great interest rate, but you're paying PMI, you still might have a better loan than if you refinance it later to a higher rate just to get away from PMI. But in other loan cases, you would have that PMI would automatically drop off for you when you hit 78% of loan to value. So when you're at 78% of the original value of your home, that private mortgage insurance will disappear automatically. But if you have a home that maybe you've paid extra principal down or the value goes up quickly, in many cases in as soon as 2 years, you can just provide some evidence to your lender that the value of your home has come up. That's usually by showing comparable homes to yours that are in that higher price range, and the lender will work with you to get that insurance removed. One nice thing about PMI is it's not a fee that your lender is charging. So if you're with XYZ Bank and you're paying PMI, that bank has no incentive to keep you paying that mortgage insurance longer than necessary. It's just protection for them. But you won't have somebody who's working against you to kind of force you to keep that PMI in place for any longer than you need to.
So I've heard of some mortgages that have PMI built into them. So rather than having a separate PMI fee, it's built into the loan. Do you advocate for those, or are those things you should be wary of?
When we have low interest rates like we do right now, it's a really good strategy, especially if your concern is how much your monthly payments are going to be, to just pay it as one lump sum at the time that you go to your loan closing. So let's just use, again, another nice easy number. Let's say that if you, instead of paying a monthly fee for this PMI, you just choose to pay it all at once, and you're buying a house for $100,000, and the total cost of the PMI is $2,000. You could either pay $2,000 in cash at closing and not have to pay anything ever again, or you can have it increased to your loan amount, so your loan amount would actually be $102,000. The difference of $2,000 in your monthly mortgage payment is going to be negligible over 30 years. So, you might see just a few dollars difference in your monthly payment, but you've already paid that PMI. You don't have to worry about what the value of your home is. It's a great strategy to do when rates are low. When rates are a little higher, if the market someday changes, this might not be the greatest strategy ever, because you might refinance your home someday, and if you've paid all that PMI in one lump sum and you refinance your home, well, you might have to pay PMI again. You won't get a refund back. But in the majority of cases these days, lump sum PMI is a great option. There's also something called lender paid PMI, which sounds like, oh, why would we not want to choose that? Well, a lot of times the reason that the lender is paying your PMI for you is in exchange for a higher interest rate. There are some first-time buyer programs that advocate for this lender paid PMI, and this can be helpful to kind of stretch your budget to make your monthly payments a little bit lower and increase your buying power that way. But as a rule of thumb, if you're paying your own PMI, you should definitely consider the lump sum PMI if you're going to hold on to the home for a while and you're not expecting to refinance it.
Yeah, that's really good. That all makes a lot of sense, and it's really, really good information. We already figured out this mortgage amount and this debt to income ratio. You already addressed this. Let's talk a little bit about just, what makes up the different parts of somebody's mortgage payment, and when you sort of add in that plus the condo or homeowners association dues, just to make sure whatever they're getting into, whether it's primary mortgage or whether it's investment property, that's going to be affordable for them.
Sure. So in most cases, the lender is willing to pay through an escrow account your property taxes and your homeowner's insurance for you. And the reason why is the bank has an interest in making sure that your property taxes are paid. If you fail to pay your property taxes, the municipality can put a lien on your home, and that's bad business for the bank, and that's bad business for you because it puts your ownership in jeopardy. So rather than worrying about having a big tax bill of $5,000 at the end of the year to pay, you can have that included in your mortgage payment. Same thing with your homeowner's insurance. If there's ever a claim on one of your homes for damages, or like a tree falls down and damages the roof or something like that, the insurance is going to be payable to yourself as the homeowner and also to the bank as the lender. So we want to make sure that the insurance part is always paid, on time, and that there's sufficient coverage and that sort of thing. So banks prefer to handle these things for you. So we'll set up what's called an escrow account. And just think of it like a bank account where maybe, $400 a month of your payment goes straight into that account, and it's just held in reserve until your tax bill or your homeowner's insurance bill comes due, and then the bank will pay them for you, and they'll notify you if those bills increase. A lot of times our property taxes will increase every few years. So now the amount, that $400, might not be enough to cover the next bill. So the lender will tell you, I'm sorry, but we're going to increase your escrows to $420 now because your new tax bill is going to be $240 more next year. Other than those two pieces, you're paying principal and interest. And principal is just your loan amount. So some dollars of your loan, unless you're in an interest-only loan, which are pretty rare and hard to find these days, but principal will go to paying down the balance so that as you're making payments, you're owing less and less and less on your mortgage. In the beginning, you'll see a lot of your payments going toward interest because you're starting out with the highest balance that you're ever going to have on that mortgage. But as you make payments, the principal balance drops. So you're paying less interest because now you're paying interest only on that smaller amount. So when you started out at $100,000, you're paying interest on all of that. When you're down to $95,000, well, now you're only owing interest on the $95,000, and so on and so on. So as you go into your loan payments over a longer amount of time, you'll start to see the proportion of your payments start to shift, where more payments going towards your principal than interest. One interesting thing is your mortgage payments, when they're calculated for you, are based on paying your full payment on the first of every month, not for a penny more, not a day earlier or later. For your mortgage statement, you're going to have a grace period where you might not have to pay any kind of late fee if you get your mortgage payment in 15 days after it's due, so through the 16th of the month. So many people think, well, why would I want the bank to hold on to my money? I'm just going to pay my mortgage on the 16th of every month. Well, those who do that are actually accruing interest on all those days of interest, those 15 days every single month where their balance was higher than what it was calculated to be. So you might see your 30-year mortgage has another 1 or 2 payments left on the back because you've accrued more interest, where the person who pays on the first is going to be done in 30 years, and the person who pays a little early is going to be done even sooner.
So do you advocate for like bi-weekly payments or extra payments towards principal if it's really going to make a huge difference in how long those mortgages last?
Well, again, if we're looking at the mortgage in a vacuum, irrespective of other uses of that money and other needs for it, then anytime you can pay extra principal on your mortgage or pay your mortgage down faster, you're going to save money on the mortgage itself. But it's always at a cost of whatever else that money would do for you. So someone who's paying maybe an extra $200, $300 a month into their mortgage is maybe sacrificing putting that $200 or $300 a month into a child's 529 plan or something like that. So you have to consider your whole financial picture when you're making these decisions. But absolutely, there are biweekly mortgages that are handled in one of two ways. Some lenders will do it for a budget assistance. So maybe your $2,000 month payment is kind of a little hard to swallow, but you get paid every 2 weeks. So the bank might take $1,000 in the middle of the month and $1,000 at the end of the month to pay your $2,000 for the first of the next month. You don't really see any benefit financially from that other than just helping you with your budgeting from your monthly cash flow perspective. But to actually save money, you want to have a true biweekly mortgage where every 2 weeks payments are made, and some of that payment is principal. So as I was mentioning earlier, you're actually paying 2 weeks early or more in a couple of months of the year. You're chipping away at that principal. So someone's 30-year mortgage on a biweekly schedule actually amortizes in 26.5 years. So the same exact interest rate, same exact loan amount, but actually just having the payments debited every 2 weeks will have that loan paid off 3.5 years early.
All right, well, that sounds like it's probably worthwhile then for most people if it doesn't cost them any extra, for sure. Can we talk a little bit about construction loans? A lot of people want to build their own homes, and maybe they're living in a house right now and they bought a piece of land, or they want to, sort of get involved in the architecture and the design of their next house. Can they get approved for a loan without having to sell the house that they're currently in with all these guidelines of debt to income and things like that? Or how do the construction loans work?
So yes, in many cases, you can qualify for a mortgage when you still own a home. You're not always required to sell the home that you're in. Although if you want to increase your buying power, then it can benefit you in some cases. And some clients of mine have done this where they'd actually sell their home for the certainty of knowing that their home's sold, for how much is in their pocket, and all of that uncertainty kind of vanishes, which is kind of helpful for some people. And it's better for them sometimes to go ahead and sell, move into temporary housing or rent back from the new owner of their home, or some sort of accommodations to get themselves out a little bit earlier. Another strategy could be to change your primary mortgage on your home, if you have one, to something like a home equity line of credit that would have a lower minimum payment and increase your buying power for the construction loan. But if we're looking at just a construction loan, in the case that you mentioned where someone owns land, a lot of times you can get into a construction loan with very little to no money down, because the value of that land counts towards that 20% down that we were talking about. We would consider that $100,000 value of your land as $100,000 of equity into the construction loan. So if you want to buy or build a $500,000 house, but your land is worth $100,000, well, you've already got a 20% down payment. You could also incorporate the cost of buying land into a construction loan and have one loan that helps you pay for the land and then also the construction costs. And during the time your home is being built, generally a construction loan is only going to charge you just the interest on the loan as it progresses. So there's going to be a very, very low mortgage payment for most of the construction phase until the very end, when we've dispersed all that money to the builder. The house is more and more built. We've paid more and more into it. At that time, that's when you'll see more of a full mortgage payment due.
So you're using the term like you have a bunch of money to lend out, and I'm going to let you do a little bit of a plug, just for this point, because I think it is important. What are some of the business advantages of getting a loan or mortgage from a small local bank that has their own money versus an online bank or a big large bank that's highly likely or pretty much guaranteed to sell your loan and pass that thing around?
That's a great question. There are a lot of benefits. First and foremost, as you said, your loan's not going to be sold. When you work with more of a private lender or a smaller bank, we're not making money in the secondary market, meaning we're just doing loans for the purpose of selling them and making money by, having you pay your payment to someone else in a month and then someone else in 6 months. That can be very frustrating as a client. I've had it happen in my personal life too, where you send a payment and now all of a sudden it's a different lender, so your payment has to be redirected, and it's such a hassle, and you don't know who you can call when you have questions. So when you're dealing with someone from a smaller bank, you know that the loan will always be with them, especially if they put in writing that they're not selling their loan to other servicers. So if you have to get, and this is so common, you need some forms for tax time, and maybe you didn't get one in the mail because you were set up for electronic billing and you don't know how to get it, you can just call your loan officer or your bank and have it pulled up for you automatically. Some of the larger banks farm out a lot of the resources to different areas. And again, you might be calling an 800 number instead of just, a person who kind of knows you, has talked to you, and is familiar with your scenario, who can give you really good advice. I think the worst thing, unless the only thing in the world you care about is rate, is to go online and with absolutely no human intervention, just try to pre-approve yourself for a mortgage or shop rates, because by the time you have someone calling you, and you'll probably have more than one someone calling you, like your phone might be ringing for days nonstop because you're being solicited, you'll find that the interest rate might not be at all what was advertised, and it's very frustrating. So I've had a lot of clients come to me that way just because of the frustration of dealing with things like DIY. You're not really saving any money. All the banks are trying to be competitive with one another. Nobody wants to be the outlier that gets no business because their rates are too high. So if you have someone to advocate for you, it's a very big word in my world, to advocate for the client, make sure that what we're doing makes sense, make sure that other considerations are made for the whole financial picture and not just the mortgage. It's just countless benefits that way.
And I've also heard that if you do go online and apply for, I don't want to name names, but
yeah,
one of those online ones, that they oftentimes run your credit multiple times. It can really have an adverse effect financially on you.
Yes. And it's very frustrating too, because again, your phone might ring day and night. Even when you tell someone to stop calling, they've given your name and number to so many other people that you're going to be doing that for a while. It's a pretty unpleasant experience, and a lot of times their rates are not even better than what you could get with your bank or your loan officer.
Yeah, I mean, it just makes sense if they're playing middleman and selling your loan to somebody else. It would be difficult for them to give you the best rate and still make money. Doesn't make a lot of sense. Hey, so obviously you have a tremendous amount of knowledge in a lot of these different areas. Obviously, you have more patience in explaining this stuff than I do. The last thing, just to mention real quick, are renovation loans available for people without having to refinance their whole home if they want to just do a kitchen or bathroom remodel? Can they get more money to do that?
Yes, a lot of times you can, without just having to refinance, it's not always the option. Sometimes it's a great option, especially when rates are down, to, pull out some cash when you've built in equity over years of owning your home and making your mortgage payments. Sometimes you can just refinance your mortgage and get a chunk of cash that you can use to renovate your home. You could also maybe leave your mortgage in place and do what's called a home equity line of credit, which would just be a separate loan, again, based on the equity of your home. The interest rate's going to be lower because the bank knows if you don't pay it, the house is there for collateral. So a lot of times it's going to be much less expensive than if you get like a big box store credit card, to fund the cost of your renovations. For something really major, like it's pretty common to see people doing big renovations on older homes to expand the size, and it's very complicated where you might have multiple contractors working in your home for different pieces. It can be risky to fund those things by you writing checks every time from having cash in the bank or a home equity loan. So there are actually some specific renovation loans where the bank can intervene and help you make sure that, like, we're dispersing the funds, we're making sure that the inspections are all done and the work is being done as promised, and be the middleman for you. There are specific loans for that for some of these larger renovations.
Yeah, that's really good information. I mean, obviously, there's a lot to these different types of options and vehicles. So, we strongly recommend that if you're in the market to, obviously the interest rates are amazing right now. So if you're doing loan consolidations, debt consolidations, refis, or purchases, you can go and talk to somebody like Ginni, or somebody that has that type of, experience with all the different options. They're not going to charge any fees at all, right? I mean, they can come talk to you. You can educate them, give them their options. They don't have to come out of pocket to pay you for that kind of advice. Is that fair to say?
Yes.
And so, we would strong. Yeah, I mean, through our nonprofit, obviously, we want to educate people. But getting a good team behind you with your real estate person and your mortgage person, your financial person, your tax person, you're able to make better decisions and leverage yourself with the proper types of mortgages, leveraging your real estate properly, selling your real estate, exiting it without having to pay taxes, making sure your estate plans are all coordinated with all these things. This is really, the importance of getting all this information together under one roof, under one team, and it's really, really beneficial. So we kind of went over a lot of things today just as an intro. We have some more in-depth, higher level, strategic mortgage and real estate educational workshops. So if you'd like to hear more in the future, or you would like to discuss other topics, please use this opportunity to fill out the survey that you are going to pop up after the webinar is closed. Let us know what you want to hear more about. Let us know what topics you like. You can obviously rate the content of this workshop. If you'd like to reach out to us directly and then schedule a one-on-one consultation or request a meeting with Ginni or somebody like her, please let us know. We are here for that. We have experts in all different fields. All of our workshops, obviously, are available to the public, and all of our one-on-one consultations are at no charge. So again, that was a quick hour, Ginni. Thank you very much for sharing your knowledge with us today. Hopefully we can entice you back to do some future presentations with us. Any closing remarks or thoughts for you?
No, I just want to thank you for your time and for providing this opportunity. I think that mortgage is one of these areas that it's just so helpful to have a grasp of how it all works and what's looked at, how to get a good deal, all those things. So this is very important information, and I'm very glad that you're sharing it.
All right, wonderful. Well, as always, everybody, please stay safe, take care of each other, and we look forward to seeing you again soon. Have a wonderful day. Thank you. Bye-bye.